Today on This Week in Startups, William Quigley of Clearstone Venture Partners is with us. He's hot off a blog post that everybody's talking about. A venture capital revival is upon us. The next 10 years are going to kick melon farmer ass. Is ass a $10 fine?
No, you're good.
I'm good. Okay, no $10 fine. Melon farmers, let's do this.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
Hello, everybody. It's a bonus episode. We've got a very important bonus episode. Let me get my show notes. Do I have enough laptops here? Let's see. I got the studio laptop. I got my MacBook Air in orange. And then I got my... Oh! There we go. It's going to be one of those episodes. Then I got... Let me just get the T off of that. It's no problem. And then I got my orange MacBook, my iPad 2. So that's about another 10 Gs for Mr. Steve Jobs. Thank you for funding and supporting this show. I can't thank you guys enough. I mean, I'm blown away by the response to the twistlist.co. So many people have wanted to become producers of the show, and being a producer of the show has become so much fun that we've doubled the price because there's too many people. We have 33 people who've signed up to be executive producers, associate producers, or just plain old supporters. And you can be any of those things starting at $10 a month and going all the way up, 10, 25, 50, and even $100 a month. We doubled the price because there were too many people signing up, and we're trying to keep this to an intimate group. And I told you we were going to do that, and you know what? We're going to wind up doing it again. So if you want to get one of those executive producer slots, you want to sign up right now at twistlist.co. What do you get for doing that? Let me pull up the website.
Mug?
You get, well, no coffee mug, no. You get to do a ton of work. I mean, and that's the truth. You're going to pay us to be part of this group. You're going to get your name in the IMDb, I hope, if they don't shut us down for doing this. But I have a feeling we're going to get the IMDb with all you guys there. You get to, at the end of the show, you get the nice little production credit that you're an executive producer. You get to say it on your Twitter account. Hey, you get to come to the yearly $50 burger lunch that we're going to have at the World Series of Poker. So when I'm on, right after I get bounced from the World Series of Poker or before I start, we're going to have a $50 burger day with the producers. But we had the first monthly meeting. Every month you get to come to a meeting and discuss with myself, Tyler, Kieran, Carolyn, and everybody else what's going to be on the show. So for example, we're doing a Bitcoin episode. For example, we're doing a roundtable on social media. You will help produce that show. You're going to learn how to be a producer of a show. This is beyond genius. It's one of the greatest ideas I've ever had, / stolen from Adam Curry. Anyway, Adam Curry's a genius. We all love Adam Curry. Kudos to Adam Curry for coming up with this idea, which he stole as well. But anyway, you know how it works. Go to twistlist.co, you type in your PayPal, and you start supporting the show. We're going HD, we're going HD, we're going HD. I'm going to make a big announcement. Broadcast picks or TriCaster 850. Broadcast picks, TriCaster 850. You're going to find out in about 2 weeks which one we're going to go with. And boy, is it exciting. Thank you to .co. Don't you know, your name is your identity online, so don't settle for ridiculous names with dashes or spaces and all kinds of nonsense in them, .lees, all that kind of stuff. Don't settle for a ridiculous name. Google ranks .co is the same as .coms. That's true. Matt Cutts will tell you. Matt Cutts will tell you. .co will rank the same as a .com, and there are a ton of them available. Get a .co, create your own opportunity. Twistlist.co. I use the product. I love the product. In order to be a sponsor of the show, you have to be a product that I or Tyler use. Now, there's overlap in that group. 90% of what I use, Tyler uses. The 10% is going to get a little weird, to be totally frank. But you cannot advertise on this program unless we love your product. And in fact, if you go to thisweekinstartups.com, we've actually started a list of companies that we will accept advertising from. If you're not on this list, you can ask to be on the list, and I'll look at your product, but probably I'm going to say no, because most products suck. But if your product does not suck, I will consider reading your ad online. And the thing is, I don't want to read an ad by somebody I don't absolutely love their product. But I can tell you I love .co, I use .co, and if you look, DNA Mail, GoDaddy, .co, MailChimp, are all on the sponsored approval list, and they all sponsor on a regular basis. Squarespace, etc. I use Squarespace for all my websites. I love it. But hey, Apple could advertise, BlackBerry could advertise, Samsung could advertise, Google Docs, Evernote, StarCraft 2, Drobo, Tesla Roadster, Plantronics headsets, GoGo Internet, Verizon Me5, Virgin America, Southwest, Wilson Sonsini, Silicon Valley Bank, and Alliance Bernstein. And I list on this thing here. Take a look. Look at this. I'm telling you, these are the products I love and use. I will not read the ad if I don't love and use the product, so stop. There's a couple of people who keep asking to buy ads. We're not taking it. Your product sucks, period. Stop calling Mo 3000 and harassing him. Anyway, .co, don't you know, .co, you'll get taken seriously. William Quigley, you've been a venture capitalist for 98 years. You've invested $400 billion. No, seriously, how long have you been in the game?
About a little over 15 years.
15 years.
Yeah.
It's 2011, so you started back in the mid-90s.
96.
96?
Yes.
Hey, good timing.
The timing was terrific.
You saw the Netscape IPO and you got in?
I saw the Netscape IPO, exactly, got in. My partners and I initially worked with a guy named Bill Gross who started Idealab.
Ah, Mr. Gross, yes. He was just
Gross.
on This Week in Venture Capital. I would say the only person who's ever made an incubator work, correct or not true?
I think that's absolutely right.
Yes.
I think, in fact, there's so much going on in incubation right now. Right. Most people still have never studied how Idealab did it and how they did it well. They created billions of dollars of ongoing market value. Right. Bill Gross, I consider him the father of the second wave of venture capital and entrepreneurship in Southern California.
Absolutely.
1996, started the incubator at Idealab in Pasadena. Only took people at the time he was an ageist. You had to be within 2 years of coming out of college. He preferred guys from Caltech.
That sounds a lot like Y Combinator.
Yeah.
But he also liked having a lot of the equity. I mean, he wanted to own 70% of the equity or something.
The great misunderstanding of Bill at the time and his model was this. Bill actually conceived the idea.
Yes.
Right? Up until that point, incubators were something that they provided you office space and maybe some computers.
Photocopy machines, some coffee, all these very difficult things to get.
Yeah, really hard to do, right?
Wow, what added value?
And Bill came and said, I'm going to start companies. And what happened was Bill was a prodigious inventor. He thought of many, many things.
That dude's got mad ADD.
He does have mad ADD. I can tell you I never had a guy ever since.
Tough to work with.
Well, he was tough. It depends how you look at it. Tough in the sense that the bar was getting raised every single day, right?
So he would not lower his standards?
Ever.
Ever.
And what happened?
So that must have been uncomfortable at times, no?
No, I loved it.
You loved it.
Well,
you're an achiever.
And I came from Disney, right? Where it was an up or out policy from the time you got in there, right? So if you didn't perform, you were gone.
What policy? Up or out?
Up or out.
Up or out. That's Eisner?
This was actually Walt, right?
Oh, wow.
Eisner inherited it, but it was up or out. And the strat planning.
Up or out?
Yeah.
I've never heard that term.
Oh, really? Yeah, that was it.
You either get better or you get out.
Yeah.
Up or out?
Up or out.
And
by the way, I think in most organizations you should still have that policy. But anyway.
That's a Jack Welch kind of thing too. Up or out.
It was. And by the way, it also depends. It also requires you, then the manager, to make sure that you're always giving that person ever-increasing areas of responsibility. So a lot of people don't want to do it because
it's hard.
Because it's freaking hard.
Yeah, because I have to be like, oh, I'm not just going to tell you.
I have to care about your career. I have to care about your advancement. I have to actually think about what are you good at and where you can go.
Right.
This was Bill.
Right.
It was a marvelous place to work and to start.
It was magical.
50 companies a year. You know, one great thing I'll mention that Bill put out in the newspaper, he was getting press all the time. He put out in the newspaper, he said to some reporter, I'm really low on employees, I need more people to show up. The next day, I drive into the Idealab incubator and I see all these cops and they're cordoning off the street, Union Street, and I'm like, what's going on? Who are you with? I'm with Idealab. You work with Idealab? Okay, you can get through. 4,000 people showed up.
Wow.
And this was before, Facebook and everything else. So great place.
Now wait a second. At Disney, you're telling me you worked with Walt Disney? No, he died.
Thank God I didn't. Walt's a great guy, but I'm not that old.
Not that old.
But that was the policy. Disney's culture didn't go when Walt went, right? I mean, and this is something I've.
So that is the testament. He did. Yeah.
I believe that the best way to think about a corporate culture is if you, the CEO and founder, aren't around, will people intuitively know what the organization should do? Right?
I like that.
And that was what Walt did. I felt in my gut when I was responsible, I was the chief financial officer for the licensing division, the world's largest licensee. I could tell in my gut.
Wait, you ran licensing?
No. I was the finance head.
The finance head of licensing.
Right.
Now that is Disney's business, isn't it? I mean, there's parks, there's movies, and then there is making swag.
At retail, it was over a $10 billion business back then.
And you were the finance dude.
I was the finance guy.
Wow.
So I saw lots of things, right? 4,000 licensees across the world. It was a magnificent place to work.
Right.
But actually how I got inspired to be in venture capital was there were a bunch of licensees, the guys who made the waffle irons and the t-shirts, that were getting acquired in the early 90s. And we were acquiring some of them at Disney. And as I started to realize, well, who's getting paid? It was these private equity / venture capital guys. And I didn't even know who they were. And as we started to talk, I said, how'd you get that job? Well, I did this and this and this.
The secret little club.
I'm going to try to do that.
All right, so now I wake up, I don't know, it was a Friday or Monday, and I see the story on TechCrunch, the gossip blog TechCrunch. Zing! And I said, wow, this is incredible. There's an article of substance about an actual issue, not Mike Arrington losing his luggage. Zing!
Thank you.
Thank you. I'm going to be here for 3 more nights. Try the veal and take care of your waiter. And you wrote a great piece. And I said, hey,
I appreciate that.
Well, we know each other, I guess, cordially
Yes.
from the industry. And,
Yeah.
But we don't hang out. They said, oh,
We dated, you know.
we dated a little bit in
You weren't
college.
my type.
Right, exactly. Anyway, wow, I said, this is a great article, and I have to agree with it. Tell us what was the basic premise of the article. I'm pulling it up here. We'll do a little side-by-side video, if we can, with the technology of the TriCaster. And tell me, why did you write this piece?
Wow, the TriCaster. Now that sounds like an innovation in itself. Why did I write the piece? Because at the end of the day, I love entrepreneurs being able to get cash, being able to get capital to grow their businesses. And the reality is, venture capital remains the best way for businesses to get capital and grow rapidly. There's angels, there's corporations, but venture capital is the reserve currency, if you will, of startups.
And it's the best. Why? Why is it the best?
It's the best because it's an institutional process, meaning every day when I get up, I have a job to do. I work for my limited partners, the guys who give me money. I have to invest, right?
So there's a level of focus that you have that maybe an angel won't have?
Yeah, because an angel, by the way, I'm an angel investor too, but let's face it, angels have day jobs.
Yeah,
right?
I do.
Right.
I am a gambler. Angel equals gambler in my mind.
To a certain extent.
I like to put that on black and I let it ride.
I feel the same way. When you put money into a deal and you're a quote angel, what you're really saying is, I like what you're doing, I hope it does well, but this is not for the college fund, right?
No, it's gambling.
This is gambling.
Roll the dice, boom.
A little bit of speculation.
A lot.
So, and sometimes a lot. Well, I'm pretty good at which companies I invest in.
Yes.
But why did I do it? Because I saw the amount of venture capital just plummeting. In other words, the amount of capital going into venture funds
It's been going down.
has been going down rapidly since 2007.
It's got a little bit of a black eye, you think? People think venture returns are like, meh.
That is it. It's the venture returns.
So let's go through this. Here we go. Put up the side-by-side. Let's get William on the on his camera. Oh, I like that little side-by-side there. So a beautiful, great zombie venture capital revival is upon us. Mark Twain, the reports of my death have been greatly exaggerated. 10 years ago, the decade began on a high note, but quickly evolved into extraordinarily difficult times. Take us through this slide. Lots of data.
All right, that slide and the presentation is on SlideShare or on my blog.
We'll link to it in the show notes too. Yep.
But the main point of this slide you're looking at now was just a quick snapshot of what the venture capital and the startup and technology world looked like back at the beginning of the last decade, so 2000, 2001. And guys, it was awful. We had gone from $12 billion in 1996 going to venture capital, and it became a flurry of activity because of the dot-com bubble. We got up to almost $100 billion of commitments into the venture capital sector.
So that means the venture community got almost 83 billion from limited partners, retirement funds, endowments from Harvard, whatever, to invest, but the market was shrinking.
The market started to plummet, and it was a confluence of so many bad things. As nice as the ride up was, it was as bad the ride down.
Yeah.
And as a result, what we saw very quickly in my world, the venture capital world, and I've said to a lot of people who were belly aching about how bad the financial crisis was, if you were on Wall Street, I believe that does not hold a candle to how bad it was if you were a technology entrepreneur, if you were in a .com business.
Oh no, you were down 98%.
Yes, you were down 98%. And by the way, not only that, it was people disliked you.
Oh, I lived it. I mean, I'm like...
They hated you.
I went from being the oracle, like the whiz kid on 60 Minutes, Charlie Rose, profile the New Yorker, profile the New York, blah, 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 blah. And then I was hated the next day. And I would never forget it during that period because somebody wrote a book that was going to be like Digital Visionaries. Then the market collapses. They renamed the book Digital Hustlers. And they just switched the whole point of the book was, here's a bunch of people who are awesome and are going to change the world. And then they were like, here's a bunch of melon farmers. See, melon farmers, huh? No $10 in the keg fund. What's the keg fund at? $30? Now you guys are, it's overnight. And you know what I said to myself? I know that's not true. I'm going to keep fighting. I'm not going to Thailand and I'm going to do yoga. Did. And I did it. And I came back and I was like, oh, by the way, Michael Jordan, boom, Weblog Zing, hello. But anyway, keep going.
That's the great secret. Of course, you have to continue to do this.
Perseverance.
Perseverance and tenacity are essential elements of an entrepreneur. But what happened was it took 10 years because when we raise capital as venture capitalists, we get the money for 10 years.
Right.
So near 2009, 2010, all of the commitments we had, that great 83 billion, 100 billion, was starting to disappear. And then we had the financial crisis in 2009, and what did people say? I want liquidity. Keep in mind, you generally can't have great returns and lots of flexibility in withdrawing your money. So the venture capitalists hold the money for 10 years because, by the way, for most businesses, it takes at least 7, 8, 9, 10 years to actually build it into a valuable business. Facebook is 8 years old. It's still not public. And so the investors, the limited partners that gave us money, really have shunned the industry. And what I'm saying is, guys, let's not look at the past, because past performance does not predict the future. We always think...
Wait, but don't people say that? Isn't that the, past performance does predict the future? Isn't that the whole point?
But the financial
track records?
Here's the deal. The finance industry has always said, when you're buying that mutual fund, past performance is not an indicator of the future because they don't want you to invest in the hot fund and have it go negative. Well, the reality is most of us look at the hot fund and we think that's where we should put our money. But rarely does lightning strike twice. Right?
I see.
And so my point in writing this report was to say, all right, forget about the hyperbole. Let's just look at the data. And the data makes a case.
Here we go. 2000, venture capital exits shifted from IPOs to less valuable M&A. VC exits from 91 to 2000. 58% of the exits were IPOs, and then in the last decade, it was 12% IPO. What does that mean? Do you think this is we're going to have a chart like this again, going from 2010 to 2020? 58% of companies are going to IPO, or will it be 40%? Certainly more than 12.
Sure. The chart you're looking at, I mean, there's a dozen different ways that we can interpret it, so I'll just give you one quick one.
Sure.
Which is, first of all, IPOs have traditionally been the best way to make money if you're a founder, if you're an investor, because
liquidity.
Public companies, you get more liquidity, and generally speaking, you get a better exit. But
because there's more people buying the shares. It's a free market.
Yes, capital, and by the way, gosh, I wish we as venture capitalists and founders could tap the public markets because there's far more people who want to invest in a public security than want to invest in a private security.
Look at the demand at second market. I mean, should there be a slide on these where it says VC exits from 01 to 09 that says second market exits?
If I had that data, I would do it.
But what do you think it would be? Tell me.
Right now,
do you think 10% of people have liquidated?
I would say it's less than 10%.
5%.
Probably in the 5% range.
So 5% of VCs who had holdings in something like, say, Facebook, LinkedIn, or Groupon, you think they've liquidated on a second market?
Yes, have reduced their position in that company through a secondary sale. By the way,
why do they do that? Just to hedge? Or because they want to look good to their LPs?
I think it's both. You obviously, when you have a chance to sell at a very attractive price, what do they say? Pigs get slaughtered. You don't want to just continue to ride it. And you're limited.
Bulls make money, bears make money, but pigs get slaughtered. Trees don't grow to the moon.
That's right.
Bank a little bit of the gain.
And you couldn't do that before. You were all in. You have to go public.
Love the second market. You think it's a great addition?
Oh, anytime you enhance liquidity for an investor, anytime you enhance liquidity for a founder, it's a good thing.
And it gives you the ability to then go make more investments.
Absolutely. Right. What do we do with our money? We recycle it.
The IPO breaks that were put on the market has been a net positive, negative, or neutral for entrepreneurship in America as a country?
Oh, profoundly negative.
Okay. 10 years later, here we go. Boom. The market is now poised for breakout performance. Conditions have improved considerably, helped by a reduction in capital in firms.
Yes.
The number of venture capital firms is down by what, 2/3?
I
All
would
the
say,
Johnny-come-latelys are gone?
yeah, at least 50%, and the amount of capital has gone down. Now, the reason, let me make sure I communicate this point. The reason it's good that some capital has left the system is that a lot of what you'd call the hot money, the people who thought, I'm going to invest and not lose anything, they're gone. Now we have the dumb money.
The Johnny-come-latelys. There were people who said, hey, I'm watching all this money go in. I'm going to start my own venture fund. That had to be infuriating for a guy who started in '96, who's been working for 5 years, and then all of a sudden somebody raises a fund twice as large as yours?
Exactly.
Did you just want to kill yourself?
Well, what I wanted to do is say, how do I follow that model? What in the reality was, though, and this is a point I think the limited partners often didn't understand.
Don't think is how you follow that model.
Yeah.
Don't overthink it.
Overthinking, you're right. That's a whole nother topic. But it takes years to become a good investor. Years, sometimes it's several decades, right? And when venture capital went from 12 billion to 83 billion in a span of 4 years, the money was easy to get, but the trained investors was not. So you had lots of money in the hands of people who frankly thought it was really easy.
Right.
Oh, I'll just put money to work. You remember that.
Sure.
.com, whatever, and I'll go public.
Flippity-dippity. IPO, here we go.
Yeah.
Theglobe.com.
Lots of examples, and in the end what happened was a lot of venture capital investors
What's the
got
number
burned.
one thing you learned as a venture capitalist? You've been doing it for 15 years. You say there's a lot of lessons you learned. What's the number one thing you've learned?
So I never answer the number one because there's so many,
All right,
but
I
will give you a couple.
Yeah.
One is, and this is maybe, it flies in the face of what a lot of people tell you, but you should invest in the trend. What I mean by that is...
So invest into the momentum.
Yes, absolutely.
So social networking, mobile,
online
group
gaming,
buying, online gaming.
Absolutely.
There's going to be multiple winners?
Multiple winners, and here it's so
a
many
trend
reasons.
for a reason?
It's a trend for a reason is one. The other, of course, is who do the best employees want to work for? They want to work for the exciting new company. So you have an easier time
People
recruiting.
want to be on the side that's winning.
Yes. And of course, the acquisition candidates. Big companies, let's face it, big companies rarely innovate. The way they do get that DNA is they acquire businesses.
Sure.
Which businesses do they acquire? I worked in strat planning, right? When I was working in corporate America. We acquire the businesses that we're reading about in the newspapers, that are reading about in the magazines. And those businesses tend to be ones that are building on a new trend.
M&A at a company like a Microsoft, Google, Yahoo, whatever big company, I'm not going to pick a specific one, but are you saying that they're trend-driven?
Gee, what a surprise, right? And why are they trend-driven? Because when they're on
They want to look good to their bosses?
Yes, and who are their ultimate bosses? Public shareholders. When you go and read those public company transcripts, inevitably one of the analysts says, but what about social networking? What's your social networking strategy?
And thus you have AOL buying Bebo in a disaster with untrained management, not thinking about it, but saying, hey, 50 on a social network when Facebook's worth 10 billion seems like a steal.
Yes, and by the way, it always bothers me that I and my firm, Clearstone, have always been in many times on the wrong side of the M&As. And what I mean by that is we sold PayPal to eBay at a price that was way, way too low.
1.8 billion.
1.8 billion. And now really
it's worth 25 billion.
25 billion and is the real value, I think, of the eBay franchise now. Overture.
It is eBay.
Overture, Bill Gross's creation. Yep. The invention of the pay-for-placement click model.
The entire Google model.
We sold that for about $1.4 billion to Yahoo.
It would be worth 200 billion as Google. Or let's say it's half Google's success, it's worth 100 billion.
Right. And
so let's see, you did about 10x less than PayPal, and you did at least 100x less in Go.
Yeah. And so what I say is,
But you still made a lot of money.
We made a lot of money, but frankly,
you want to kill yourself.
The Clearstone people, the Clearstone family, did not want to sell those companies. It was the other board members and investors who said,
you were not in control of it. That's one of the unfortunate parts of being a VC.
That is. In
so
fact,
everybody thinks the VCs have the power, but in fact,
it's complete BS. Right?
You don't have the power because if I'm a crazy entrepreneur and I decide
can do what you want.
I'm going to go off the reservation, what do? What is your backup plan? You're going to come in and run Mahalo?
I've said, right. What do we know, right?
Exactly.
We're finance guys, right? That's what we really are. And a lot of VCs say, oh, I'm not a finance guy. Look, at the end of the day, you are investing money.
There's a reason why you're investing money and not starting companies.
That's right.
Right. You're good at what you do. I'm good at what I do.
That's exactly
That's why it's just like the TV dynamic. Hey, listen, if you're running CBS and you're Les Moonves, you're not Charlie Sheen. You can't do what Charlie Sheen does, and you're going to let him smoke 8-gram rocks all day long if he's getting the ratings.
That's probably right.
You don't care if your entrepreneurs are off the reservation. You care if the metrics are going in the right direction.
That's right. And so it's very, very difficult.
You like an off-the-reservation kind of entrepreneur, let's be honest. You like a little crazy in an entrepreneur.
Of course, because at the end of the day, who attracts a lot of the juice in an organization? It's the guy who's doing something innovative.
Somebody calls you, I'm on the management team of X company in your portfolio. our CEO is crazy, he's too demanding. What is your first initial thought?
I rarely get those calls.
Really?
Right?
You don't get people ratting out their boss on the management team? You've gotten them.
No, we've gotten calls like that, but they're generally more around we're moving in a weird direction, or are the company's cultures kind of dysfunctional? It's those kinds of things. Usually the entrepreneur who's pushing his team faster than they really think they can go, we don't get complaints about that. Then we may have people quit because they can't deal with it. But people like that energy and excitement.
Is that a good sign or is it a bad sign? When you see like people quitting on an entrepreneur because he's pushing him too hard?
I think it's a great sign.
It's a great sign.
I think it's a great sign.
You love that.
I do.
Okay.
I do.
All right.
And
I
I've
just want to
seen
be clear.
Too many examples of where, because let's face it, if you're really comfortable.
Have you seen a lot of examples of people who don't push hard enough?
I think that's one of the biggest issues.
That makes you worried as an investor.
You know, too many people talk about Steve Jobs. But I will say this about him. One thing he does is he constantly pushes.
Right.
And he makes people go crazy with how much they have to do.
Do you have to be an a-hole to be a CEO of a successful company in the internet business, technology business?
I don't think you have to be an a-hole.
You have to be an a-hole sometimes?
Yes, of course.
Okay.
Of course. I mean, at the end of the day, I remember once there was a guy named Warren Bennis, who's this famous thought
Warren Bennis,
leader.
yeah, of course.
Yeah. And I actually had a course with him when I was at USC. And he said...
Is Warren Bennis alive?
He's still alive.
Yo, get me Warren... Producer Kieran, I want Warren Bennis on the program.
One of the great thinkers in business. Yes. But his point was, managers and leaders get people to do what they otherwise wouldn't do.
So in fact, if left to their own devices and given a ton of carrots, they wouldn't necessarily get the mission accomplished.
No.
You need to have somebody behind them saying, hey, the carrots are over there, but there's a stick in this hand as well.
It's called leadership.
Hey ho, venture capital fundraising has been declining since 2007. This is the amount of money that LPs are raising. But there's a little peak here in 2007 when things got hot. Financial crisis, rich people don't have money, and boy, did we fall off a cliff.
We did. And here's
Is that because rich people are poor?
Well, remember, the vast majority of capital that goes into the venture capital funds comes from endowments, university endowments. It comes from a large percentage comes from the state pension plans. What's been going on with the states?
They're bankrupting themselves because they're mismanaged. They're idiots.
They've got financial performance problems.
I can say, you can't say they're idiots. But they're idiots. They don't know how to manage.
And one other phenomenon that you're looking at now, which is the rise of clean tech. Clean tech's wonderful.
Everybody wants to be in clean tech.
Clean tech actually took some of the capital that would have gone into traditional IT and dot-com tech investing, and instead it went into clean tech investing. And so as you look at the amount...
So clean tech is up 8x.
Clean tech is up a lot. Now, by the way, if you were sick as a limited partner of waiting a long time for a return in traditional IT investing, I actually think you're going to be waiting even longer at clean tech.
Well, now here's an interesting statistic. The U.S. economy has grown almost 50% since 2000.
Do you know what's funny about this?
We are on a roll. This is what people don't understand.
Yes.
We have employment problems, we have housing problems, but companies are becoming more and more profitable. Earnings are up. I keep telling people this. It's not about America. It's not about the unemployment in America. It's not about the housing prices in America. It's about AdSense in China. It's about Groupon in Europe. We are running the best companies on a global basis, true or not true?
Absolutely true. And the point that I was actually very surprised about when I presented that slide to a large group of people, knowledgeable people actually, business people, I got several questions of, wait a minute, the U.S. economy grew over the last 10 years?
Of course it did.
I was amazed. People thought the economy had actually shrunk. Now, the point
it's all because of international, correct? I mean, all these companies, internet, that's a big difference than 10 years ago. 10 years ago, you were an internet company, you made 90% of your revenue in the United States.
Yes.
Now it's 2010, you make 50% in the United States, 50% out. In 2020, what's the ratio going to be?
Oh, I think, well, let's look at one sector that I'm very interested in, online gaming.
Yep.
In online gaming, which today probably the U.S. provides about 50% of the global revenues.
Talking about Zyngas.
Zyngas and all the others, World of Warcraft,
gotcha.
You know, those types of businesses.
Okay, 50% U.S.,
50% the U.S., 50% rest of the world. By 2015, it's estimated the U.S. will account for 10% of global online revenue.
Whoa.
Global online gaming revenue.
Right.
Meaning, if you're an online gaming company, a Zynga, for instance, or a Playdom, now owned by Disney, and you are not looking at the global markets,
you're missing all the growth.
You're missing more.
100% of the growth.
Yeah.
It's flat in the United States.
Yes.
I mean, when you get 90 people playing Farmville or whatever they peaked at, it's obvious that you've saturated the market. If 1 out of 4 Americans is playing frackin' Farmville, I'd save myself $10. I love that. I love Mark Pincus, is my boy. I knew Mark Pincus when he was, I mean, I know Mark Pincus for a long time, but I knew him before that. But let me tell you something. I was out with him boating one time. I don't have to tell personal stories, but anyway, we're out. Lake Tahoe, whatever, we're hanging out. And my wife always remembers, for then growth at the time, Pincus going, I don't get respected. Like, Kleiner Perkins, like these guys or those guys, like I want to build $1 billion company. He was like really frustrated with Tribe, and I need to get respect. And boy, did he just, Michael Jordan, tongue out, boom.
You know, this is another point I will make about great entrepreneurs. Nearly always, they have a little chip on their shoulder about something.
Of course.
If you don't have
middle
a chip
child,
on your shoulder,
daddy didn't love them enough.
Right.
They fought with dad. They got middle child.
Absolutely.
They got their ass kicked or something, and they're going to prove to the world.
They're going to prove to the world they've got something.
Absolutely.
By the way, to your point on percentage of revenues globally, the S&P 500, right, the major companies in the U.S., more than half of their revenue now comes from overseas. You look at a company like Coca-Cola, 80% of its revenues come overseas.
Yet. With all that revenue overseas, none of it makes it repatriated back to America because of this stupid tax law that Bush and Obama bi-party idiocracy, we want to charge them 50% on $1 and they won't bring the money home.
No, this confiscatory rates of taxes that happen when you make money overseas. You want that capital to come back into the U.S., change the tax policy. But look, that's an act of Congress.
Make it 20%. Make it 25%. Let's get that money back.
I actually have a belief that that will happen in the next few years.
It has to, because we're taking that money and investing it in entrepreneurs outside the United States.
Right.
They're buying companies like Nokia, whatever they're going to buy, these companies outside the country.
Yes. And by the way,
that sucks for me.
There is a phenomenon going on that we also didn't see in the last dot-com era, which is foreign companies now increasingly buying U.S. companies. Lots of them, lots of tech companies. That was M&A.
Well, because it's not a fair market. If Microsoft could bring and Google could bring all that money home and buy American companies, it would be an M&A field effing day.
There's an estimate.
Bring the money home, Obama. Bring it home.
More than $1 trillion is in U.S. corporate bank accounts of companies overseas. Yeah.
And nobody knows about this issue. Yes. All right, let's go back to your slides. Here we go. Venture capital assets under management are lower than they were a decade ago, but the opportunity is much greater.
And that's really staggering to me. So the slide you can't see, probably maybe the viewers can look at, but in 2000, we had about $24 billion of total assets under management that all the venture capital firms are managing. 10 years later, our economy has grown 50%.
And it's down 20.
And it's down to 180 billion. It's down 20%. This makes no sense. And by the way, if you're an investor and you're looking for where to put your money, here is a rule that always works, which is returns flow to areas where capital has been receding, almost always, because as capital recedes, as capital goes away, the capital that is there can take better advantage of all the opportunities that exist.
They get more leverage.
Right.
They're more effective.
Less competition. Yeah. And returns tend to go down when capital floods into it.
Everybody leaves the muni bond market, the prices get lower, there's a buying opportunity.
Yes.
And then everybody rushes back in, it's a selling opportunity.
You're seeing this right now in the housing market. People are deciding, hey, I'll go into housing because so much capital has left the system. The venture capital community, when you think of cloud, online gaming, social networking,
group buying.
Yeah, group buying, the innovations in
e-commerce,
all of those things happening. And by the way, we had a third of the U.S. in the year 2000 who had internet access. Now the majority of the United States has internet access, much of it broadband. The opportunities now are many-fold what there were, and yet 10 years later we have less venture capital.
It's insane. Here we go. Venture capital fundraising as a percentage of GDP has rapidly fallen. $14 trillion in GDP. You made this slide, or you found this somewhere? It's a good slide. I've never seen anybody compare these two statistics.
Thank you.
So we have GDP at 14 trillion or so in 2000, and the percentage of venture capital fundraising, the amount of LPs funds, money that you guys raise, was about, what does that say there? About 0.8%?
Yeah, a little over, call it roughly almost 1%.
1%.
And now
that seems about right.
Seems about right, about 1%.
1% of the economy. Right. Yeah, hey, we make this much money.
Going into really risky stuff.
We're going to invest into risky stuff.
Yes.
And then we get to today, it's 0.1.
It's almost zero.
Almost zero.
This is crazy. That when I saw that chart and one of my analysts put that together, I said,
who? Give him a shout out.
This is
who's the analyst?
It's Kevin Finn and
Kevin Finn. Good job. You got a shout out on.
And also Claire, both from USC MBA program.
Oh, good.
And what I would say is both both venture capitalists and, frankly, people in government should take note of this and say, we should be putting a lot more capital to work in this sector.
Tell you what, maybe we stop a war or two and put $1 trillion into this.
Wouldn't that be wonderful?
Yeah. Okay, so consider American Reinvestment Act and Recovery Act of 2009 with $787 billion given to the Ferengi at Goldman Sachs and other banks. I added that little part. That's an ad lib. New commitments to venture capital funds in 2009, $15 billion. Let's do that one more time. The American Reinvestment and Recovery Act, also known as the bailout of the bankers who caused the problem. I don't mean to have a bias here, but giving bankers a huge bonus of American taxpayer dollars, $787 billion. New commitments to venture capital firms in the same year, $15 billion. Something is wrong here. But after a long shakeout and attractive conditions ahead, venture capital fund commitments down for the last 3 years. Positive contra-indicator. We talked about that. Early stage valuations are stable, while late stage and IPO valuations are growing. Early stage, though, we've seen them go up a little bit.
Now they're going up, right?
Okay, but not crazy.
Not crazy.
But there's been some crazy moments.
Yes.
So we say, what? It's not a bubble, but there's a little bit of froth?
I'd say there's a little bit of froth, and like all things, though, keep in mind, in any market, there's a bear market and a bull market simultaneously.
Right.
It's
so the angel's bearish. The other end of the barbell's bearish with DST buying stuff in second market, and then in between, maybe there's some good value.
Yes.
Strong public market appetite for growth stories. Recent IPOs in the enterprise and consumer services sectors went
incredibly well received.
I mean, Tesla in green, and LinkedIn will be huge.
A local company here, Green Dot,
Green Dot, yes, that's a Sequoia company.
Yes.
Shout out to Michael Moritz. Venture capital firms, only the strongest survive the post-bubble shakeout. So the smart kids are still here. The dumb kids got eaten by the lions.
Yes, and by the way, who do you want to be putting your money with, other than, if you were an investor, other than the venture capitalists who have survived 2 tremendously difficult recessions, the dot-com bubble bursting in the late 1990s, and then you had in 2008 the financial crisis. The venture
and also, by the way, some of those venture capitalists were also around in 95, 96 when we had a little like mini bubble burst. It was like the post-Netscape hangover.
Right.
I don't know how we contextualize that, but it was sort of like a mini closing of the public markets for 18 months.
Well, for a while, you're right. Something a lot of people don't realize is that Amazon.com, it went public in 1997. It was actually a year later trading below its IPO price.
It was a dark period. Here we go. Venture-backed IPOs will return to pre-financial crisis levels in 2011. I agree. Looking at about 80.
Think about the class. We talk about these great classes. 1986, you had Oracle, you had Microsoft. You know, and of course,
companies built to last.
Yes. 1998, we had a whole slew of great companies, including eBay. Well, the class of 2011/2012 is going to be
legendary.
Legendary.
Juggernauts.
I mean, we're going to be LinkedIn and Facebook,
Groupon,
Zynga, and Zynga. You throw
Twitter,
throw in Yelp, right?
Huge.
Pandora. I mean, we've got such a phenomenal class. Now you've seen too, Zipcar. Much of those companies are consumer internet companies. The market is really excited about those because how fast you can grow.
They're global consumer internet companies.
When else, right? Skype. It'll be Skype, Facebook, or Tencent. But one of these businesses in the next, call it 18 months, we'll do what, if you're familiar with Singularity University, one of the things that the folks at Peter
Thiel.
Peter Thiel, I think, is a part of it too. Talk about there is that
Peter Diamandis.
Peter Diamandis. The goal is to hit 1 billion subscribers, 1 billion users.
The march to 1 billion. Yeah, it's gonna be Facebook.
Facebook or Skype or Tencent.
I think the Skype purchase today, by the way, it's just Microsoft building a Facebook competitor. I think they're going to make Skype profile pages into a social network. But let's get back to this. Well, what do you think? Am I crazy?
I was disappointed that Facebook didn't acquire it. I thought it would have been a much better fit.
So dumb. Why would Facebook not pay the price? They got so much money.
I'll tell you one reason.
That's a momentum buy.
Well, yes, but I'll tell you one reason. This is some.
That's like shooting some threes when you're up 20, man. Let's do it.
There is a mystery that I still can't figure out because I'm not on the Facebook board. Why they haven't gone public yet? Had they been public, they would have.
You think there's a shoe to drop? Legal shoe, something like that?
I don't know. I don't know. I just think they should be public, and they would have been able to buy Skype.
Why didn't they
and as a user, I'd prefer that Skype were owned by Facebook than were owned by Microsoft.
Oh, wait, you're saying Facebook should be public by now?
Facebook should.
Yeah, why aren't they?
Absolutely.
Oh, I think they're sandbagging. I think they have 12 billion. I think they could have 10, 12 billion in revenue right now instead of 5 this year.
They could. I think they're
under monetizing by a factor.
They should be public. You can do so much more. Think about the people who questioned Google going public.
Yeah.
The great advantage they had being public. But,
maybe
a topic for a different show.
Do you think they want to wait and see what these other companies do when they go public?
No. I think Facebook will be like PayPal going public in 2002.
Really weird. Oh, maybe is this legal action with that guy who says he owns half of it?
Could be.
Maybe there's some shoes to drop there that are embarrassing. Oh, yeah. So here we go. VC environment today. Valuations moderate, rising, capital available, adequate, stable, fund commitments $12 billion.
The point of that slide
down.
is just the situation, the landscape is quite good for founders and early stage investors.
And not bubbly. Have you heard the maxim the venture model is broken in the last 6 months? Only 20 times.
Right.
Are VCs being rewarded for their work anymore?
That's the real question that question asks. Are they being rewarded for their work? And the answer, of course, is profoundly yes.
Oh, yeah, people are making bank.
Yes.
But now, do you want to even say that here on a program like this with 100,000 viewers that Forbes just said is the best television program on or off the net?
Congratulations.
Do you really want to say that on a program like this that is watched by 100,000 people and then have all those numbnuts start venture funds again and we go through this whole cycle?
Well, as I said, to be a great venture capitalist, to be a great investor, like anything you do in life, you have to spend a lot of time. It's an apprenticeship.
10,000 hours, Malcolm Gladwell, he said it. More so than early textiles, private investors are being rewarded. And for the breakouts, let's look back at the so-called venture capital golden age. How were the iconic tech companies of the past valued when they went public? Good question. Microsoft? Whoa.
Microsoft was valued
1.8.
as a $650 million valuation. The reason that's astounding to me is that it was at that time already considered the dominant desktop operating system worldwide. A relatively low valuation. Cisco went public at a $225 million valuation. You can keep going through this deck. Amazon.com, at the time it went public, it was
people hated it. It was a dog.
But it was the world's largest e-tailer, $400 million valuation. Going for Juniper, the great challenger to Cisco, went public at $1.5 billion. And Electronic Arts, still the largest gaming company, $73 million valuation. And the reason that's so astounding is you look at companies that have gone public, and I think gone public since Google. Google marked the end of an era and the beginning of a new one. The new one is public companies now are valued, or when private companies go public, they're valued at levels never before seen. This is a great thing if you're a private investor. If you're a private investor now, if you're an employee, a founder, you're getting rewarded for your efforts like never before.
So this is a sign that LPs might want to start getting in the pool again.
I think so. The point is, if you could have invested at Cisco at a $200 million valuation, why would you bother being in that company for 5 or 6 years prior to going public and do all the hard work? Just buy the stock. And by the way, 9 years later, Cisco is worth $550 billion. 99.5% of all the value created at Cisco was created in a way that the public investors could participate in. The same for Microsoft, the same for Amazon, the same for eBay. The point now is if you want to capture the majority of the value of these companies, you have to be in the companies before they go public, which means if you're a big investor, you need to be investing in venture capital or be a founder.
William Quigley of Clearstone Venture Partners. Thank you so much for this incredibly insightful episode and slideshow. There's about twice as many slides where you go into the mobile and to the global sort of situation of what's going on that I highly recommend you go check out. Go to thisweekin.com/startups and we'll have the PDF there and a link to it. Clearstone Venture Partners is clearstoneventurepartners.com. Or is it?
It's clearstone.com.
It's just clearstone.com.
And then the Quigley Report.
And the Quigley Report at clearstone.com, or is that your?
No, just the QuigleyReport.com.
Oh, okay. That's where you do your own writing, I take it?
Yeah.
Congratulations on really like creating something that's become I mean, it's a #1 slideshow on SlideShare.
Yes.
Which means something, and a really well put together. So kudos to your analyst. And I love this format of the show when we have somebody who's well informed, and then me, needling them a little bit, and then all these great statistics. I mean, really, you think about it, it's such a great thing when somebody puts their heads down. And you spent 2 months on this, I take it?
Yeah, probably.
You spend 2 months on something and the quality goes up. Not everything's about a blog post about your lost luggage or this other nonsense going on in the world or about an IPO. Everybody wants to cover the nonsense. I love when somebody just puts their head down and spends 2, 3, 4, 8 weeks on something and you get some quality out of it. Thank you so much, William Quigley, for being on the program. Thank you to .co for sponsoring the program, and thank you to all of my lovely, lovely producers at twistlist.co. If you would like to be one of my lovely, lovely producers and be at the $50 hamburger lunch and be at the monthly call and be on the email list where we're talking about all kinds of crazy stuff, all you got to do, twistlist.co. We'll see you next time.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.